And one of the skills in that category that I think it doesn't get mentioned exactly like this is actually the value of being a really good listener. And I think a lot of the opportunities that come up with someone that you're going to do business with, whether it be an investor, you're listening for things that are said, but a lot of people also communicate important stuff in what they don't say. Being a good entrepreneur, you're trying to pick up on things that maybe the market or other people may not be picking up.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today, our guest, he is an expert in multifamily investing. He was a top producing agent in Manhattan for many, many years, actually in the top 10, since 2002, now runs a successful multifamily investing business. He was recognized as commercial broker all-star for the past 4 years by a New York magazine. Now he's investing in numerous places all over the country, and he brings a ton of insight into multifamily. Today, his name is Peter Von Der Ahe, and Peter has been a friend of mine for a couple years now, and his knowledge is deep in multifamily specifically. You're going to hear him lay out a number of things that are going to be value to you today, the investor and operator, if you're looking to invest in multifamily, especially as he lays out what he expects to happen over the next 6, 12, 18 months. Very valuable for anyone listening today. Peter, welcome to the show. I've enjoyed getting to know you a little bit over the last couple of years and spending time with you, and I'm honored to have you on.
Awesome, Whitney. Great to be here, and looking forward to our conversation.
Yeah, me as well. You have, you were a top producer, Marcus and Millchap, for so many years. No doubt, so many lessons learned there that now you are, just growing from and have grown from in so many ways. I'd love to hear a couple qualities right off the bat, or either actions that you took just consistently that helped you to perform at that level for so long.
One of the things that comes to mind off the bat is, especially the early parts of growing the business, when you're by yourself, is I tried to add one new kind of needle moving capability or aspect every year. And, so generally, that cadence would pick up, and this would be something that, it was big enough that it would take a year to implement, either a new skill or some new aspect of the business. It could be a new market we're going to try to focus on or something like that. And if you're consistent and you execute that could by the way also be team members and people that you're working with. And then as you grow and you build people around you, you can do 2 things a year or 3 needle moving things a year. I think is interesting about that is you start to see the exponential nature of consistently executing on something on a day-to-day basis, a month-to-month basis, and then doing it with team members. And then they start doing that as well. That's when you start to see the real magic happen. Because when you're by yourself, you're adding 1 thing a year, maybe 2 things a year. But if you work with a couple of really talented and good people, now you can add 4 things a year, 6 things a year. And you do that for a couple of years in a row. And you'll look back and you'll be very pleased with the growth. Hopefully, if you have some luck and the market rewards you as well. So that's something that comes to mind.
I love that, the focus on something that's needle moving, but it's got to be something pretty substantial to take a year to implement like that as well. But man, after implementing that, that's a big deal. But I love the aspect you talked about. Oh, after you start growing your team, well, now we can do 2 of those things per year, right? Or 3 of those things per year. Speak to maybe 1 or 2 of the biggest needle movers, over that career.
Well, I think in the early part of my career, and especially kind of the early part of becoming an entrepreneur, you're focused a lot on frankly, some of your communication skills, and obviously reading a lot of entrepreneurial books, sales books, and all the these type of things. And one of the skills in that category that I think it doesn't get mentioned exactly like this is actually the value of being a really good listener. And I think a lot of the opportunities that come up with someone that you're going to do business with, whether it be an investor or, in my, earlier career when it was, you're trying to do transactions, you're listening for things that are said, maybe they're explicitly said, or they're said kind of, under the breath or whatever, in a less explicit way. But a lot of people also communicate important stuff in what they don't say. And so I think, being a good entrepreneur, you're trying to pick up on things that maybe the market or other people that you're competing against or whatever may not be picking up. And a lot of that, I think, can be found in listening. And you pick up, whatever, you have any conversation with anyone, you pick up a plethora of information if you're just a really good listener.
No doubt about it. I feel like it's a lost skill, but man, I think it's one you have to really be focused on.
Yeah. So I know that's not necessarily from the technical side of things, but I just found little things like that were very foundational. And I could always tell when that was not being done. If you met with someone or frankly, you're interviewing someone, you can tell if they're not a good listener. So anyways,
give us a little bit of backstory into the multifamily career, why multifamily and some of the early days, what you can share up to, and how you've grown in that.
Some of these things are like, more of a feeling, but, thinking about why I was attracted to multifamily, there was something about that I intuitively picked up, like the scalability of it. And, there's kind of two aspects of that. The one is this, you're coming up with a business system that you're going to apply to one unit, and then you're going to be able to scale it across many units, across many buildings. And there was something that was really, I don't know, that caught me somewhere. And then the other part of that is just the diversification of income streams. So, you compare against some of the other asset classes. And, this is nothing new about multifamily, but I think over the next couple of years, as we see what's happening, if you look at what's happening with office right now, what happened a decade ago with some of the retail properties. So that diversification of income stream is really a major component of the safety of this asset class. And even the people who are you'll see in the press, right now, and then probably over the next 12 to 18 months, the investors that are getting hurt, it really doesn't have to do with the operations. It has to do with how they financed and how they organize their capital stack. And, that's totally different than what's happening, for example, in office buildings. In office buildings, you have a tenant that's leaving and you're 50% vacant. That's not what's happening in multifamily. And so when you get down to the root causes of what is behind some of the car crashes and some of these investments, that helps you, you're seeing through a lens that's helping you identify what risks you are good with.
Just your track record in multifamily definitely just lends to learning, a lot of learning, right?
A lot of learning, yes.
From other operators and whatnot over the years. I know that you were just heavily focused, New York City for a long time. I speak to that, focus there versus, man, are you, now being willing to maybe go to other markets or, that transition?
Yeah, for sure. Yeah. I started my multifamily career, running a transactional business in New York City. New York is interesting because, as one of my friends said, he said, it's like everything is upside down in New York. He's like, in the business in New York, you're trying to get the tenants out of the building. He's like, everywhere else in the United States, you're trying to get tenants into the building. So in New York, really, when you add the regulations and the politics and a lot of the, very local, this is how you get something done type stuff. It's a unique, subset of the asset class in that geography. To give you an example, the average hold time for a building in New York City is like 60 years. So that is well above that's much longer than every other market in the country. And so there's this kind of also generational aspect to holding the properties that occurs in New York. So in true fashion, it's also a complete, it's like the epitome of the melting pot in terms of the type of people that own the buildings, the various backgrounds. So in my experience there really gave me a look into all, some of the operational complexity. You're dealing with, kind of jumping from, these vastly different scenarios with, vastly different operators who may be coming from, different cultures or different ways they came upon the buildings themselves. And so you had to be able to switch contexts and communicate these different contexts or, messages, whatever you're trying to do. And you had to do that very, very quickly and without much fluff. So, it's a great learning point.
Yeah, no doubt about it. How has just the regulatory changes that have hit there, right? That have changed I feel like the outlook on that market in a massive way, right? Affected how you choose where to invest now.
Well researched and publicized, but the more you kind of restrict the housing, what you're going to do is you're going to depress the interest in it. You're going to depress the availability in it, which is actually going to create the opposite effect, which is going to drive up the cost of housing. I call it a war on housing in New York for years and years and years, with all the regulations that really were left over and just slightly modified since World War II and never completely eradicated. And then beginning in 2015, they started to, after in 1997, I'll back up. In 1997, you had a governor and a mayor who kind of worked together to start to ease some of the housing restrictions. And what that did is that ushered in like a whole opening up of many parts of New York, many parts of the boroughs. The places where people would live in Manhattan actually grew substantially, and actually grew throughout New York. A lot of the neighborhoods now, you talk about there's restaurants in Brooklyn and all this type of stuff that didn't exist 25 years ago. People were not doing those type of things. And so one aspect that allowed that to happen was the easing of the housing restrictions would allow capital to go into all these neighborhoods and start upgrading the property. And then lo and behold, people start moving in there and bringing in, and then the retail follows and all this kind of stuff. So that you had about an 18-year run there from 1997 to 2015, where those restrictions were eased, and you saw this real kind of flowering up of all these neighborhoods. And then starting in 2015, the pendulum started swinging the other way. The restrictions started coming back and shifting back. And then in 2019, they really put a stranglehold on, on what you could do to vacant units. And so a lot of what you're seeing today, I think, a lot of the rent increases are sky high. The cost of housing and stuff is sky high again, but also the quality of housing, by and large, has deteriorated a lot. One of the major New York Community Bank, went under several months ago. They were the biggest lender on a lot of these multifamily properties. So the restrictions came in, depressed the values. Now you have the lender impacted, the bank goes down. It's very hard to find a lender right now who will finance those properties. So it's kind of like the quality of housing goes down because the owners don't have money to invest they may have the money, but it doesn't make financial sense to invest in the quality of the buildings. So it's like this cascading ripple effect where they keep kind of hitting something on the head and expecting a different result. So, I don't know what else you want me to say. It's a tough situation where the incentives are misaligned with what the hoped outcome is.
Interesting to think back through just the history that you just listed out, though. Right. And how that, what happened, you said in 97, right, when the governor and mayor started making some positive changes, sounds like, right? And we're on a mission to improve that. And then, man, it just seems like we can learn from that, but
I mean, it was right there. Yeah. It was, yeah. You don't have to go all the way back to, the 70s or two. I mean, you had plenty of data right there. So,
speak to how that influences the markets you go into now, though, personally, are you looking at history like that? Are you thinking about obviously those regulations that are in place locally?
Yeah, I mean, I think the whole intersection, it really highlighted the intersection of politics and business, and most Americans are so tired of some of the negative effects of politics in whatever, pick a subject, and there's plenty of material where the politicalization of whatever is actually, it's a net negative. But so I think it makes you think about that, just that aspect from a lens. I had started investing outside of New York, probably 15 years ago. So there was that diversity, and it's a big country. You don't have to. As I said, after 2019, the local governments there were basically kind of declaring war on investors in those markets, and it's a free country. You don't have to do that. You don't have to fight that war if you don't need to.
For sure. Peter, I guess, all the listeners, or many ask me often and want to hear from guests, especially experts like yourself, just the outlook, right? Your expectations over the next 12, 18 months. And while none of us know the future, I say, what we believe is going to happen definitely affects what we do, whether we're buying or selling or investing or not. And so, everybody, I know the listeners, just want to hear from your experience. What does Peter think that looks like, and how's that affecting, the decisions for your investing?
Yeah. So I think in a couple big categories, we're in a really interesting time. So, first of all, let's just talk about supply, the amount of new apartment deliveries, broadly throughout the country. There are a couple markets that highlight this, but sometime over the next 6 months, we're going to hit peak supply and deliveries in most markets. And, the past couple of years have been higher than the past 15. And, because of the drastic rate rise that started at the end of 2022, it's no secret that all new development, a lot of the new development for new supply essentially falls off a cliff at some point in 2025. And so, from an investor standpoint, that's a buy signal. So you want to buy into an area, you want to buy into markets where you're going to have a little leverage with supply. And then if you start going down to other categories, like, for example, let's just take expenses. In the past couple of years, we've had a decent amount of expense inflation in all categories: labor, cost of materials, various other aspects of operating a property. So you've had some really significant expense increases for the past couple of years. We're starting to see in our operations that the pace of those increases is coming down a lot. So not that they're not high, but they've been high for a couple of years, and everything has a cyclical nature to it. So we may be heading into a period where the increases are just not as severe. So and then and you look at that, and then if you go to income, for example, because of the supply, we've been in markets where rents have essentially been flat for about 2 years. Maybe they've been up slightly or down slightly, depending on exactly your submarket or where the market is. But by and large, they've been, call it flat. So if you just look at those aspects right there, you have expenses, rents, and supply. It seems like we over the next 24 months, we could be going into a world where our rent growth is going to, begin again. Your expense growth should be moderate. You're not going to have a lot of new supply that's going to be causing competition. And then the final thing is that really affects values and transactions is where interest rates are. I actually think that because of the lag of reporting with the economic data and the gap between what some of the headlines say and what is actually happening on the ground for most Americans, most tenants, that I think we'll have. I feel like we could have 2 rate decreases this year. Maybe it's 1, maybe it's 2, but you can't predict that stuff exactly. But if you look at over the next 12 to 24 months, I think rates are gonna come down. We don't know how much, but just say they're going to come down. When they do, the asset prices rise. And so, to me, if you put all those things on a chart right there, I'm seeing this as an opportunistic time to buy. I think it's always a good time if you're to buy good real estate. And then the fifth category of this is, well, what happens with the distress that's out there right now? Not all. There are people and investors in deals that are impaired. They had floating rate debt. They got hit with insurance. So there are things that people are navigating right now, and we'll see how that gets resolved. I think operationally, most the buildings are occupied and most of them are doing well. But if you have a problem with your capital stack, generally like how your property was financed, or do you have pref equity, or were you underfunded in your ability to make renovations, and renovation costs were too high? So are you undercapitalized and you couldn't complete your business plan? Like things like that happen so those will play out, and they may present little opportunities. And I think, may or may not, but I don't think these are going to be so severe that they're going to have a massive impact on the market. And I would say my caveat on all of this is that I think the reason why you're not seeing massive amounts of distress is that, the economy is doing pretty well. People's wage increases have been a lot higher over the past couple of years than previously. And, so our lack of a recession and the overall health of the economy is kind of like a guardrail on what's happening with the operations of these multifamily properties. And if you compare this with the great financial crisis or something like that, that's where you really saw rents decline, occupancies decline a lot. You had you had a lot more distress on the operational level, which then had a cascading effect. And so I'm just pointing out the contrast between the two. People say, oh, well, market goes in cycles, and they do, but not everyone is the same. And so the distress people are having right now is way different than the distress that they had after the great financial crisis, when that was a recession. And so I just want to point out those differences, because if we do have a little recession, that is going to bring up the distress level from an operational standpoint. And, so that may create, a new set of challenges for existing owners, or opportunities for people who are putting new capital to work. So, I think that's really the outlook in the short term. We try to, I think one of the kind of silver bullets in this conversation is, or in this, point of like, when do you make investments, is thinking about the length of your investment. And you're buying a well-located property and it's high quality, and you know how to execute the business plan. We're always looking at things through a lens that's greater than 5 years. Maybe it's 7 to 10. And when you do that, that allows you to, in your underwriting and in your projections, see past and see around the corners of some of these shorter term bumps.
Love that. I appreciate the detail, Peter. I think it's so helpful for the investors that are listening, as well as they're And I know they're getting deals, maybe not as many as they were a few years ago, but they are getting opportunities, to invest with a number of operators. And these, that's a great list of things, like, just to think through when they're thinking about this market that they're considering investing in, or with this operator, just what's happening there, what's happening just in our economy nationwide. But just to really break that down, and I think about the investor that high net worth listening that's looking to invest in our space in multifamily, but a lot of this seems kind of, oh, wait a minute, that seems so complicated to me, right? And I'm just not as smart as Peter, or whatever it may be. Break that down to maybe some simple things that the passive investor listening should think through as they're considering investing with an operator today. How you would just maybe even high level screen that investment opportunity based on what from what you just outlined.
Yeah, I mean, I think you want to break that down into a couple of categories, because I think you're going to screen who the operator is and who you're actually putting your money with. There's a phrase that says, you can't do a good deal with a bad person. You can't do a bad deal with a good person. And, so I think obviously that you're investing with someone who's going to be the steward of your capital for a certain amount of years. And so that's obviously got to be the first thing. And there's a whole list of ways you would assess the quality of your investor. And I think you want to know about yourself when you're doing that. What your strengths are. Some people are very instinctual and they're less data driven, and some people are the opposite. And I think you want to have a little bit of self-awareness of where you are on that spectrum and make sure you fill in the opposite. So, maybe you're very much of a data person, but there's a real story for this particular submarket, and the data is holding you back, and you need someone to help explain the story to you. Or maybe you're a story person and you can get sold, but if you don't have the data, maybe the underwriting's not going to work out. So I think you want to know who you're investing with, how they're structuring things, what their incentives are, and all these. There's so many questions there. It's none of them on their own are very complicated, but there's a lot. And then I think you got to know who you are. So, and that would be one of the things that I think about investing in real estate that's out there, is that none of these individual subjects by themselves are really that complicated, but it's really, you're taking, you're kind of taking the salt of all of these factors at once and trying to synthesize them all and make a decision. So, your question is really, well, how do you simplify it down? And so, one of those is we'll look at you're looking at who the operator is right off the bat. And then the second is you're going to look at you're going to want to look at what the financial incentives are. So the financial incentives for the operator and how the property is financed. And I would be looking at that through a risk, from a risk lens. And just what we were just talking about a minute ago about the groups that are having trouble in this market. They financed with short-term financing that was floating rates. So rates went up, and that impacted the cash flow, the viability of that investment. So I'm not saying that would be a bad way to do a deal now. Maybe in this market, that's a good way to do a deal. It depends on the deal. But you just want to go in with your eyes open what those risks are so you can make an assessment. Maybe that impacts, well, how much of a check am I going to write on this deal? Am I going to go big, or am I not going to go big? So I would look at, how it's financed, what the incentives are, goes without saying. How much is the operator putting in on their own? When do they get to take out the money? We always look at how much money is coming from cash flow and how much is coming from the sale, from a projection. So with a good Excel model, you can make anything look great on paper. There's just a few dials you have to turn and the investment looks great. So I think, you're going to want to look at that. And then, then the rest are, real estate attributes that we all know about, the market, the quality of the asset,
Sure.
what the execution is. But a good operator, I always think that when we make an investment, if you ask me about investment, I can tell you in 3 bullet points, maybe 5, but probably 3 main ones that are the reasons why we like this investment and why if we just execute on those 3, it'll be good. And I think you're going to look for that type of precise understanding of what the investment is and why it's going to be good. And it makes me think of, I've heard of interviews of people who describe entrepreneurs, and they say, oh, they're great risk takers. They're such risk takers. And the response is something like, actually, they're not risk takers. It's because they're so good at finding the ways to eliminate and limit the risks. And so I think you're going to look for that if you're making an investment with someone or making any investment is, okay, well, if plan A goes wrong, we always strategize out. We have plan A, plan B, and plan C. And so you're going to want to look for things like that. Well, what if that doesn't happen? How do I make this investment successful in spite of plan A not working? And then if plan B doesn't work, how do I make it successful in spite of plan B? And if plan C doesn't work, well, can I at least get my money back? So, and I think, and a good operator can actually walk you through how to do that. And, so if you're buying at a good basis and you have a good plan, there are ways to really limit the risk. And, you have to ask yourself questions. Would I take a 10% return with a 50% increase in risk, or would I take an 8% return and know that I almost have no risk of losing capital, for example? So there are little, ways to think about that. And, you see investors, sometimes they chase a couple extra points of return, but their risk went up by 2 or 3 times. And so if you have an event like what we had 2 years ago, where interest rates double, all those people's equity got wiped out. So it really wasn't worth it. So that concept that we just talked about is not complicated on its own. If that was the only thing you were looking at, real estate investing would be really, really easy, right? But it's, you're looking at many different factors and trying to synthesize them.
Love how you broke it down to like 3 bullet points. And I think that would help so many investors, as we have conversations about projects or opportunities, and it can seem very complicated, right? But I love that. Hey, here's the 3 bullet points. They're the main things you need to know about this opportunity. We execute on these things. It's good. We're good.
Yeah. You cover 75% of the ground if you just execute on those 3. And we like stuff like that,
Yeah. Yeah. And before we move to a few final questions, Peter, speak to the type of projects that you all are looking for now. Like, what makes a deal for you today?
So we like to have 3 things going on at a time. So we like to be providing the equity and in partnership with one of the merchant builders or developers. So we like to be building something new, every year. The reason why we like to do that is because you're putting capital to work today, and then, the property is not going to be developed for 2 or 3 years. You're getting something new. You're getting it at a price because you're taking the development risk that, that's a better price than you would have bought it new. A lot of the competition for new properties is very high. It's because they're new. They're usually in good areas, So it's a way for us to get access to those type of opportunities, and also to diversify our portfolio in terms of quality. And then beyond that, we generally buy, we buy existing multifamily. We'll buy some older stuff. Generally, it won't be more than 25 years old, and then all the way up, depending on the market, we may buy something that's new, that's in lease up. There was a time period after COVID when so much of the market was lurching toward value add properties, and they were buying value add properties at 3% returns. You could buy something that was new for 5.5, and they were going to experience the same rent growth that the entire market did for a couple of years. So we've bought stuff like that. We don't have we're boutique, and so we don't have these guardrails that limit us in terms of where we are focusing. So if the opportunity in the market is to buy something new, we'll focus on those deals. And if 9 months later it switches, kind of like what it is now with the lack of financing and stuff, and where it's maybe more in the value add space, then we'll look at those.
What's the biggest challenge right now, Peter, for you versus, I mean, like, is it, and not wide open here, but I'm gonna narrow it down here is it capital or projects, properties to invest in?
The biggest challenge is always finding great properties and great opportunities. What I would say is, the biggest challenge, just in terms of in this seat as running an investment firm, being a steward for people's capital, it made me think of it. You're making me think of an example of the crypto markets. So, so I've made some crypto investments on my own, and I've done okay. Maybe I should have done. I had opportunities to do better. But I also invested with a specialist who, with a firm, with a track record, with a process, with a discipline. And the returns that they generated in the crypto market were like 10 times what I did on my own. And, in looking back and assessing why they did that, why they were able to achieve that, it's because they were in their specialty. They had a discipline. They had a process. They followed it, and that produced the patience that gave them the opportunity to generate the returns. So, so when you say about what's difficult, I think, that's part of it. If you're an entrepreneur, you want to be running every day, and sometimes the market is saying, pause right now. And so I think you're always looking for the right opportunity, but sometimes you have to pause while and I don't mean pause like don't work, but don't spend right now, because in 6 months later it'll be better to spend. And so that's hard. That kind of goes against the entrepreneurial instinct. So I'd say that's related to the finding new opportunities, but there's always things, if you're running a business and you have employees, there are always things, internally you can improve, which improve our investor experience, or, improve, you can improve properties, you can do renovations. There's so many things to do. So
what are some of the most important metrics that you track? It could be personally or professionally.
Personally, I try to get a lot of sleep. And then, professionally, we track a whole host of metrics. We have our an internal scorecard in terms of, the new opportunities that we're looking at, and we'll look at, who we're buying from, how long they've owned it, and all, like a whole host of little things that will kind of create dials for us. This is maybe not a specific metric, but more of a concept. So, I'm big on, in terms of just how we run our company, that you have a cadence. We have a weekly cadence, we have a monthly cadence, a quarterly cadence of things that we do, meetings that we have, or things that we're talking about, or maybe, as the leader of the company, I'm in charge of bringing in a new theme that quarter or that week or whatever. And so, that's not exactly a metric, but I think, I think in in this world, you get rewarded for consistency. And so I really try to focus on, things that foster that inside our company, and that'll translate to what happens for our investors.
Love that. Kind of in the same thread here, what are some of the KPIs that you all are strict about that allow you to know that you all are progressing, even if, hey, there's not a ton of deals to do right now? What are some things that that, hey, this is the most important things that we need to track?
Oh, so yeah, I mean, that's, so like from our acquisition standpoint, I mean, it's we're tracking outreaches, how many deals did we underwrite? How many did we offer on? Like, so for example, if I look back over the past about 6 months, we've underwritten 141 deals. Out of those 141, we actually offered and liked 23 of them. And then we really liked 3 of them. So out of that 141, we would have bought 3. And we ended up not buying any of those 3 because we got outbid by less than $1 million probably on all of them. So there's a little bit of feedback there for us. But and we know the velocity is very low, especially the past 6 months of the market. So this is just in the multifamily category. We've bought some other stuff during that time. But so those are our KPIs on the acquisition front.
Love that. Well, what about? Go ahead.
Yeah, I mean, you were probably going to ask me on the management.
That
side.
Or investor relations, any of that, any KPIs there?
Yeah. So we have we call it a PPT. Anyways, it's our property performance tracker. So we have a weekly page that we're tracking, from the data we get at the properties, and then our weekly meetings with our managers. So there's a whole host of data that we're tracking. Obviously, you're tracking, the biggest ones: occupancy, turnover, new applications, and some of the expense items, that may be coming. The concept there that I think is important to highlight in terms of tracking is that if you're looking at your property's financials, what you're actually looking at is something that occurred 2 months ago. So if you're only looking at the income statement, you're going to solve a problem that happened 2 months ago. And by the time you implement the fix, another 2 months is going to go by. You could be in a problem situation. So all of our metrics that we look at on a weekly basis to us are either giving us current day information, or they're trying to give us a glimpse into what the operations are going to be like 30 to 60 days out. And so then when you combine those two, we're looking at the financials, which are showing us what happened, 30 to 60 days ago. And then we're looking at our other trackers that are showing us, okay, here's how the property's performing. Here's the way the operation should be 30 days from now. Taking both of those together, really gives you a firm seating in terms of, being able to assess, okay, where is this property going right now? Is it stable? Is it going up? Is there something we have to, watch out for? And, so it's interesting.
Yeah, love that. And just the focus on keeping the close eye, because no doubt what you said, if you're just looking at the financials, you're 2 months behind, and you implement something, it's 2 more months, and man, you're so far behind then, it's going to be so hard to recover, right? Just something to think through for, especially investors listening, as you're considering the operator, right? Their relationship with management, or do they manage in-house or not? Or even if they don't, like, what does that communication look like between them and the management team? And so what about, Peter, some habits that you're disciplined about? You've talked about consistency a few times, and I love that. We did 2,000 daily shows, for this podcast, and I could see our growth, related to that, right? At LifeBridge, and just that daily consistent action for so long. And I've seen that in other areas of my life as well. But what about you? What are some habits that you are disciplined about that it's like, man, I know if I keep doing this thing, whatever, I'm going to have success in this way?
Yeah. I mean, like, I do things that are well known in these communities, but you try to own your morning. Like, I have my mornings down to like 5 or 6 things, and hopefully nothing gets in the way of that. I mean, it's life, so every now and then something does. But so I'm very disciplined about that. And the other thing, I guess, is just like coming to mind is, as leading an organization, I'm not perfect at it, but I'm aware of the need to be disciplined, of not to brainstorm to your team out loud and kind of scatter them. And so I try to be disciplined about keeping our direction clear. So either it's weekly, quarterly, whatever that's going to be. So because I think that as kind of the lead communicator, you can really save people time, save them frustration, and really amplify your results if you're really clear about, okay, this is the direction you're going. And if you're a good entrepreneur, or like a typical entrepreneur, that's what the direction we're going this week. But inside your brain, you may have 20 other things that you want to do the following week. And so that actually takes some discipline to, edit some of that out and decide, all right, when are we going to have a kind of free flowing conversation about, either we're going to change this process or we're going to add something new, and then distinguishing that between, okay, this is actually when we're setting the direction. So that's another area where, where it takes some discipline.
I don't know if I've heard anybody else ever say that. I like that, though. It's like, don't brainstorm to your team out loud in an effort to keep their direction very clear.
Love that. I mean, well, we've all had that situation where you have eager team members and, you really appreciate their effort, and you happen to, at the end of the meeting, start talking about something off the hook, kind of off the cuff. And then you realize a day later, they've been starting to work on it, and you weren't sold on that. Was, maybe that's not the right time. You were just brainstorming, and you've kind of like rocked the boat a little bit. I try to limit the self-inflicted wounds.
Yeah. And you love the ambition, right, by your team. Yeah. However, sure. Man, you also hate to crush them after they've like shown that drive to go start on this thing before you even hardly mentioned it. Right. And, I think that's very wise, though. And I don't think I've thought about that enough. It's like, cause I will brainstorm often with some team members, and probably, should probably be more clear that, hey, this is just brainstorming. We're not going to do any of these things this moment. Because as if you're a visionary, I mean, you're just constantly thinking of stuff, right? Or ways to improve processes or whatever it may be. Yeah, love that.
Yeah.
What about if you had to pick one thing that's contributed to your success, Peter? What would that be?
Relationships, for sure. Relationships. So, personal success, professional success. Without a doubt, I can point to key relationships that, because of that relationship, they either introduced me to an opportunity, or that became a great friendship, or, we learned something, and I would include in that relationships. You don't necessarily have to know the people today. I think it's so interesting. I have four boys, and, watching their access to information in the world we live in. As teenagers, they have so much more access than I did growing up to if they choose to find it, to really good, really high quality information. So,
yeah. How about Peter? How do you like to give back?
How do I like? We obviously we support, charities and organizations and stuff like that, that are meaningful to us. And I don't know. And, I don't know if this is going to sound hokey, I guess, a little bit, but I think it's also a daily practice.
Yeah.
So I think, I think as a, once again, like as an entrepreneur, you're basically hardwired to come up with solutions and make things better. And you can do that. There's like a plethora of ways, like throughout every day, to do that. And they can be in small interactions and big. Yeah, like we have like our own set of family values, and one of them is to leave things better off than the way you found them. And that can be like something as simple as picking up a piece of trash that 5 other people walked by and didn't pick up. So, I try to, definitely not perfect at it, but try to live that way. And, sometimes you can make people laugh. You can come up with an idea. There's a never ending stream of opportunities to do that.
Wow. Peter, I appreciate you sharing that, because I love that you even have family values. Like it's documented. It's very rare anybody does that. But man, it's so crucial because for us, as we've tried to implement like a family compass, right? I've talked about on the show before. It's like, it gives you something to point back to, right? When a behavior happens in the family, it's like, well, wait a minute, does that align with these family values, right? But even as adults, like it helps us to think about those things too that we're modeling as well, right?
100%. And my oldest is 17, and my oldest is 17, my youngest is 8. And I would definitely say that if you do them correctly and they're concise and meaningful, they definitely work because they will be like hardwired and imprinted in your kids' brains. So I think one of our first or second one is look for be willing to have short-term pain for long-term gain. And the whole concept of delayed gratification is like discussed. It comes up every week in some little, minute example, but so things like that. So that's in all their brains. And I know like it's in there, like it's not coming out, it's in there. They will be able to refer to it. And so I think if they're done right, they're really valuable.
I think it's funny that lesson right there, I think has come up every day the last 3 days in our house. So that's so funny. Yeah. Peter, I'm very grateful for your time, your generosity with your time, but also just your experience and knowledge that you've shared today with listeners and myself. So valuable. I mean, you've just listed so many things about multifamily, even just the history to think through in New York City specifically, but even just in our economy as well, as investors are thinking about opportunities that they need to be considering or not, but even as leading a team, a number of insights that you drew out man, I don't think I've heard on the show before. So grateful for how you've given back to us as well. How can the listeners get in touch with you or learn more about you?
Yeah, awesome. Thank you, Whitney. It's been a pleasure doing it with you and, getting to know you also over the past, couple, 3 years. So that's been fun. And you can go to our website, mfpcap.com. There's ways to reach out to us there via email and stuff like that. So that's mfpcap.com. And really appreciate your time. And thanks for having me on.
Awesome. That's a wrap, Peter. That's the end of the show.